Hi guys, this is Forex with Tibilo and you're welcome to my channel. Today we'll be using gold as our case study. So a lot of times people have asked me, why don't you trade gold? Does supply and demand works on gold? And yes, I used to trade gold before. Yes, I used to trade indices before, but now I just focus on currency, just only currency. So now today I'm going to using the supply and demand on gold just to show you that it actually works for those that are always interested in trading gold as a commodity. So but for today's example, we'll be using the demand aspect of the supply and demand strategy under the smart money concept. So this is gold on the 4 hours time frame, and I'll be showing you from a demand level how you can get buy trade. So just looking at this structure that we have, you can see that when markets pushed up here to this level, markets pushed down to this level, and from this level again, markets impulsively moved up, breaking above these highs right there, then tapping into this supply level that we have right there. So now, and as you can see, over time, market is now trading back gradually. Market is now trading back gradually. And where is price coming to? Market is coming to this demand level right here. Why is it coming to the demand level right here? It's coming to this demand level because this demand level was the inception of this pull to the upside that broke above that high right there. So knowing that now, how do we then capitalize on knowing that this zone we could take a buy trade from there? So the first thing now, after doing that first analysis of checking where price is going, is for you to mark out this demand level from the higher time frame. So we are on the 4 hours time frame, and as you can see on this particular leg of push, market left huge imbalance and price is now coming back to fill this imbalance and to mitigate this demand level. So now once you have that level marked out, you then want to wait for price to come into that zone. Okay, so once price is in this zone that you've marked out, you want to now go on a lower time frame and start marking out your structure. Start marking out your structure in a way that if you want to buy, like I always say, once market tap into your demand level, market is now going to start before market push back up, there will be mini structures on the lower time frame that pushed into this zone, just like this: high, low, high, low, high, low, till we get to the last low that tapped into the zone. Then for you to take a trade, you wait for the last lower high that pushed into the zone to be taken out. That way, that gives you that confirmation that market is going to pull back up, that market is not going to go beyond this demand level that you've marked. Okay, so once this is broken, you can then look for a level around this zone that broke above the last lower high that pushed into that demand level. So at this particular leg, there will be an imbalance or an unmitigated demand level. Okay, so now that's just like a graphical representation of what I'm about to show you. Now let's move to this particular chart right here. So as you can see, market is starting to push, and price now finally got into this level. So at this point in time now, you start looking for a break above your structure. So as you can see, market pushed down here. We had a high, we created this low, we created this high, market pushed down, created this high, then market pushed down finally into the zone, and we'll now be waiting for a retracement. Okay, so once we have that break above this level right here now, once we've marked that out, this is the last lower high. Market has now taken it out. Please note that it might even just be a very small wick that took out that zone. It is a break of structure. Okay, because sometimes some people will ask, but the body of this candle did not close above this high. Can we say that is a break of structure? It doesn't have to be a body totally. It might just be weak, as you can see right here, that this is a break of structure. This took out all of this lower high that pushed price down into this level of demand. Okay, so once we have that break of structure now, this then gives us that confirmation that price will no longer push down, that the market is now turning from this bearish structure that we are seeing right there into a bullish structure. So let's have that marked. So in this leg of push to the upside now, we can see that market left behind this imbalance that we have right here. So from this imbalance now, let's just play the markets. Let's see if we have down candles. Okay, so as you can see now, from the imbalance that markets created at this level, when we broke above this high, markets will always retrace back down to the leg of that push. Okay, so just right here now is where you can then take your entry. Okay, so your entries can be gotten from inside this imbalance, or you can also take your entry from the 50% of this box using your Gann boss tool. This is the Gann boss, so you can mark out the this zone. So you can also take your entry from the 50%, but as you can see on this particular trade, market did not exactly get to the 50%. Also, you can see that in some scenarios, markets will actually push down. These down candles will push down up to this region, mitigating this zone very well. But right now, markets just used the imbalance. It just filled the imbalance partly, not totally. Market just filled the imbalance right here, and market started pushing up. But if we go to the 1 hour time frame, at this particular level, market did use the 50% of the imbalance on the 1 hour time frame. Let me show you that. This is why backtesting is very important, so that you can see how markets react from different zones. With backtesting, you'll be able to know, okay, sometimes I can take my trade once price just taps into an imbalance, or you can take your trade at the 50% of an imbalance, or you can take your trade at exactly this open of the imbalance. Okay, so now let's see, this is the 1 hour time frame. Let's see how price came back into that zone. So as you can see right here, market came back to the 50% of this imbalance. Okay, so it's from here. You can take your buy trade from right here. Then your stop loss needs to now be at the last swing low. Okay, so that your trade can be well protected. Okay, because markets can actually push down more to grab more liquidity or mitigate this last zone properly. So you want to have your stop loss at this extreme low. And for take profits, remember from the analysis from the higher time frame, when market was pushing down into this level of demand that we marked out, market left behind this huge imbalance. Okay, so with our knowledge of imbalance in the foreign exchange market, we know that markets will always come back to fill up imbalances, right? So with this now, we can look to target these imbalances for our take profit level. So if you were on this trade, this zone will be a good zone to exit your trade. So your entries, your exits, and your stop loss zones are very, very important. Okay, so you want to be getting into a trade at the right time and exiting at the right time. So this is yet another supply level that market could actually retrace from after pushing up. So you want to get out before before the market will retrace back down. So let's just move back to that lower time frame and see if this trade will be a profitable one. So now we are already in the trade, and market is now moving. The trade is now in profit, and okay, market is still pushing up right there. So as you can see, market is gradually moving to, so this is actually not a day trade. So if you are in this trade, you are going to have to hold for a long time. But if you are a day trader, you probably want to step out at zones like this as well before the day close. So as you can see, on this particular day, when price moved up, before price started dropping down, you could have exited your trade. This is over 180 pips. So if you are a day trader for the day, you can target about 100 to 150 pips on gold, actually, not on currency pairs. In a day on currency pairs, you might not get more than 50 to 70 pips in a day, but on gold, commodities, and indices, you can actually get more than that. So if you were a day trader on this day, you can look to take 100 pips and be out. And this is another day, because as you can see, this box right here is the Asian range box, and so this is another day for the London session. Market came back and reacted off this level of demand right here to continue the buy trade, and take profit was finally it right there. So you can see that demand and supply also works on commodity pairs, on gold, on silver. So whichever pair you trade, this is just a clear example and a clear representation of demand and supply on gold. Okay, so I think that will be all for this trade. I just thought to show you an example that supply and demand actually works on gold. All right, guys, that will be all for this video. Until next time.